There is a misconception that election years mean poor performance for the stock market. If you look at the return of the S&P 500 in all election years going back through 1929, the average return of the S&P 500 is 11.6%. Now, in the year following an election year, the average return is 10.7%. So really, not a huge difference between the two in an election year, the year after an election. But the point is that market returns aren't necessarily going to be poor just because it's an election year. Yes, you can see higher volatility in the short term as the market tries to figure out who's going to win the election. But generally speaking, we see that volatility smooth out or lessen after the election has been decided. So the important thing to remember here is that even though the election cycle might make investors nervous, the data shows that there's no reason to be nervous. Ride through the volatility in the short term if there is any. Stay focused on the long term.